Last year in August and September, I remember many articles coming out about how Michael Burry of The Big Short had said that index funds and ETFs were the next CDO. In saying this, Burry was saying that they were essentially in an asset bubble, and that they were the next thing to bet against. Back then, everyone was essentially dismissing him and his thinking, but he has been proven right to at least some extent. Today I'll go into why index funds are distorted and how we can take advantage of this bubble, so stay tuned. Hi everybody, welcome back to The Contrarian. My name's Logan. I really like to talk about overall success investing, as well as going against crowd mentality and how crowds usually tend to make mistakes. I also want to make a disclaimer that none of this advice I give is actual advice, so don't take any of what I'm saying to be actual advice. Just make your own decisions and make sure that you know what you're investing in. So if you like these kinds of topics, just consider it. Only 6 months after these initial dismissive articles and videos, Burry was proven right. The COVID-19 spark set ablaze the dry tinder that was index funds and ETFs, and crashed them over 30% in a matter of weeks. The only reason they stopped here was the Fed stepping in with stimulus and interest rate cuts. But Burry was essentially proven right in his initial thinking. Let's go into what he was initially saying about index funds in an interview with Bloomberg. Burry initially stated in his comparison to CDOs, which were the bubble that mainly contributed to the collapse in 2008. Let's look at the interview. Burry, who made a fortune betting against CDOs before the crisis, said index fund inflows are now distorting prices for stocks and bonds in much the same way that CDO purchases did for subprime mortgages more than a decade ago. The flows will reverse at some point, he said, and it will be ugly when they do. So in this, he's essentially saying that there has been massive inflows of capital into these funds, and since the amount contained in them is so immense at this point, the assets will collapse when the flow is reversed. Picture a rubber ball. When it is overinflated, it can potentially expand past its normal point without popping, and just simply permanently deform the rubber. But when it faces the slightest stress of a pinprick or pebble against the rubber, it will fail. The same thing happened with CDOs back in 2008 when everyone was buying them in prior years, with no fundamental analysis to what they contained. And Burry argues that this frenzied mentality simply has moved over to index funds. Let's get back to the interview. Central banks and Basel III is essentially a bank reform policy that happened as a result of the 2008 collapse, have more or less removed price discovery from the credit markets, meaning risk does not have an accurate pricing mechanism in interest rates anymore, and now passive investing has removed price discovery from the equity markets. The simple theses and the models that get people into these sectors, factors, indexes, or ETFs and mutual funds mimicking those strategies, these do not require the security level analysis that is required for true price discovery. Basically what Burry says here is that just like in 2008 with CDOs, very few people buying index funds actually examine them and look into them the way that they would with asset prices. I, for one, can relate to this. Most of the time, I ask an acquaintance who has an IRA, 401k, or personal investment fund what they're investing in. I get the response, well, my advisor recommended the SPY ETF or the blank mutual fund or the blank index fund. So that's where all my investment is, but I trust their analysis. I've heard this too many times to remember. Imagine all the trillions of dollars people have saved up for retirement that have been put into these ETFs and index funds simply because of them being classified as stable by the analysts and investors. This is no different than what went on with CDOs. It's the exact same process. In the interview again, this is very much like the bubble in synthetic asset-backed CDOs before the great financial crisis, in that price setting in the market was not done by fundamental security level analysis, but by massive capital flows based on Nobel-approved models of risk that proved to be untrue. Burry is essentially saying that because there is no analysis done to the companies inside every single index fund, their prices have become inflated. Look at Amazon stock, for example. Walmart has 2 times their yearly revenue, but Amazon trades at a PE ratio of 121. and in value investing, anything above a 20 or 30 is generally considered expensive. Look at Walmart. It has a PE of 25. Which one do you think is cheaper? Amazon is nearly 5 times more expensive than Walmart. How did this severe overvaluation happen? It's because Amazon is included in nearly every ETF and index fund there is. It's just such a large company that basically everyone looking to create an ETF or mutual fund includes it due to its stock liquidity. Look, I think Amazon is a great company, but it's just way overvalued right now, and it's no fault of their own. Ask any analyst or advisor if Amazon is a good buy and they'll tell you it's one of the best. But do they really know its fundamentals? Anyway, I digress. Back to the interview. The dirty secret of passive index funds, whether open-ended or closed, or ETF, is the distribution of daily dollar value traded among the securities within the indexes they mimic. So Burry then goes into why index funds do collapse. They will fail in a cataclysmic manner. It essentially has to do with liquidity in the stock and the effect of indexing on this. He goes further into detail. In the Russell 2000 index, for instance, the vast majority of stocks are lower volume, lower value traded stocks. Today I counted 1,049 stocks that traded less than 5 million in value during the day. That is over half. And almost half of those, 456, traded less than 1 million during the day. Yet through indexation and passive investing, hundreds of billions are linked to stocks like this. The S&P 500 is no different. The index contains the world's largest stocks. But still, 266 stocks, over half, traded under 150 million today. That sounds like a lot, but trillions of dollars in assets globally are indexed in these stocks. The theater keeps getting more crowded, but the exit door is the same as it always was. All this gets worse as you get into even less liquid equity and bond markets globally. So he gives a lot of data here. Basically, imagine that on average, company XYZ trades $5 million in capital every day, meaning $5 million flow in and $5 million flow out. Now remember that for every seller there must be a buyer. But what happens when this company XYZ is included in an index fund when it formerly was not? All of a sudden it has buyers who are simply purchasing its shares because it's in the index. They're not looking at its fundamentals and seeing if it's really what they want. They're just buying, say, 10 shares of the S&P 500. So they automatically buy some shares of XYZ. All of a sudden there's a net inflow of capital, let's say 6 million in per day and only 4 million out. Over time you have the potential for billions in capital to be locked up in this company's stock, but still only a tiny amount of daily capital flowing out. What happens when everyone in an index fund sees it beginning to drop? Or, for example, a pandemic hits and everyone needs some money that they stored up. All of a sudden you have many multiples of the average selling volume hitting the sell button. What happens? The supply is much greater than usual and the demand is lower. Prices drop dramatically oftentimes. Look at the Russell 2000 and how much it fell in just the 6 weeks of the bear market, down nearly 40%. These kinds of moves were previously unheard of, but they definitely would have continued had the Fed not stepped in. So you might be asking, what can I do in order to avoid this coming avalanche in index funds and passive investing? As I covered in a previous video, Burry is definitely not the only one predicting a significant crash in index funds and the stock market as a whole. David Hunter is predicting one as well, for mainly different reasons, but he still comes to the same prediction. So again, disclaimer, this is not investment advice. Why would you ever want to listen to someone on YouTube? Don't take this as advice. So number one would obviously be to not buy index funds or passive investing in the first place. In fact, if you really want to stay safe, maybe don't open any new positions at all right now. If so, make sure that they're only just temporary. But there's also a way you could make significant money in this volatile of an event, but it does contain more risk than a normal investment. You probably know what I'm talking about, and I'm referring to shorting index fund ETFs. You could short them by buying the inverse ETF, and this would work out, but in such a volatile event as what Burry and Hunter and other investors are predicting, buying put options as a hedge could pay out big time if these indexes were to crash, even just 50 to 60%, not the 80% Hunter is predicting. Now I have to warn you, I'm definitely not recommending you do this. Since put options do have a time decay, they will expire worthless if the underlying asset does not fall to or below the strike price by the set date. but Burry was actually betting against index funds back in March when they were crashing. And we know this because of another interview we had with Markets Insider. Whether or not he exited these positions is unknown, but he definitely could still be short index ETFs if he purchased long-term put options. I have had a significant bearish market bet that is working out for now. The money manager who made a fortune betting against mortgage securities after correctly blah blah blah. It was a good size wager against indexes, but he declined to offer more details. Now again, I'm not recommending you do this. I'm not even sure if I would do this right now, since markets are unpredictable and options do expire at a set date. But just saying, this would be a way to profit if you want to take that risk. Anyway, let me know what you guys think. Are index funds going to collapse? Are Burry and Hunter right? What do you see happening? Are they completely wrong? Am I completely wrong? Anyway, like to see what you guys think down in the comments, and I hope to see you again.